Ford Motor Company is one of the largest automakers in the world, but is the stock a buy for 2025? I'll answer that question in this video, evaluating Ford's revenue growth, its operating income, its cash flow from operations, and comparing it against its valuation using two different valuation methods, the forward price to earnings ratio and my discounted cash flow valuation model. So let's jump in. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. Ford has demonstrated excellent revenue growth ever since the economic reopening. You can see that huge dip there in revenue in 2020 as a result of the pandemic, but it wasn't because customer demand decreased for car sales. It was because of supply chain shortages. Ford wasn't able to produce as many vehicles as customers wanted. But as soon as supply chain constraints eased and Ford was able to produce as many vehicles as customers were willing to buy, revenue has absolutely soared up to 182.7 billion. That's up from around 160 billion on a trailing 12-month basis in 2019. Now, some of this growth, in fact, a large part of this growth is due to higher prices. Ford and other automakers have been able to increase prices significantly over these last several years due to rising inflation and a limited availability of cars at lower price points for everything outside of electric vehicles. Consumer demand for electric vehicles has not been great, and this is one category where there's been significant competition and price decreases. Tesla is slashing prices, Ford is slashing prices, Chinese automakers are slashing prices. Nearly everyone that produces and sells electric vehicles has been cutting prices, offering attractive lease terms, 0% financing, trying to get these cars off of dealership lots where they have been sitting around collecting dust. But for traditional internal combustion engines and hybrid vehicles, they have been selling robustly. Ford's been able to capitalize on that trend, increasing revenue as the average selling price for vehicles has increased meaningfully since the onset of the pandemic. Still, despite those increases in sales, Ford hasn't been able to increase margins. The operating margin at 2.05% is about where it was a decade ago, right around this level, after experiencing significant volatility. I've been talking about the car business for several years, and this is one of the reasons why I don't like the car business. Very few car companies generate healthy profit margins. There is always a persistent oversupply of cars in the market. I shouldn't say always, because during the pandemic, there was a shortage of cars in the market. But what I should have said is there's always an oversupply in manufacturing capacity for cars in the market. There is something like manufacturing capacity for 110, 120 million vehicles annually, and the most recent figures suggested there were sales of around 85 million units in the most recent year. So you have this oversupply where anytime there's a slight increase in demand, vehicle manufacturers boost manufacturing, and that offsets the pricing power for these automakers. They're not able to generate those higher prices when demand increases because supply just comes online, increases relatively quickly to meet the increase in demand. Save for those brief months during the pandemic when there were shortages and dealerships were able to quote prices. I remember calling a dealership looking for an SUV. This was around 2021, I would say. And they quoted me at $10,000 above MSRP for an SUV that was around a $35,000 price point MSRP. That's the kind of market we had for autos in 2021, when typically for a $35,000 car, it wouldn't be uncommon to get a discount from a dealership of up to $5,000 off the price, maybe even more, depending on the supply and demand of that particular model during a certain point in time. So there was unprecedented circumstances in the auto market, and it's still not back to normal. It is normalizing, but it's still not back to normal because those unprecedented circumstances were so wild worldwide and the fluctuations they caused. At the same time, you had governments worldwide trying to stimulate more sales of electric vehicles. And so you had all of that going on in the car market, and Ford's ability to manage all of that wasn't done very well. You compare that with Tesla, which absolutely thrived during those unprecedented circumstances when every other car maker had trouble with supply chains. Tesla was able to produce at maximum capacity and capture significant market share, while traditional automakers and larger automakers struggled to find the components to produce their vehicles. And a similar story with Ford's cash flow from operations to sales. In fact, this has been trending lower over the last decade. Used to be around 10%, now at 8.15% in the most recent trailing 12-month period. And I suspect this will be around these levels going forward. I don't expect a structural improvement in the auto market. In fact, I expect a structural worsening for US automakers because of the rising competition from China. They've absolutely capitalized on this shift to electric vehicles. They've been the beneficiary of this shift to electric vehicles because they've been able to produce electric vehicles at much lower price points than the US automakers, and they've been able to sell those at large volume and even export to other markets that were traditionally dominated by US automakers. And so that loss of market share is going to hurt these US businesses, Ford included, longer term. And the last metric I'll look at before we consider valuation is return on invested capital, which is also very low at 1.82%. I've been talking at length about automakers and the large capital investment required to maintain these businesses. They've got to invest billions of dollars in their manufacturing and update them consistently. Also invest in research and development for newer models, because if you don't, then your competitors will, and you'll lose market share if your models are getting older and you have newer models coming in. I talked about Tesla. Tesla's been losing market share in electric vehicles in several of its biggest markets because of that fact. It hasn't added new models other than the Cybertruck. It's been relying on the two models for the better part of the last 6-7 years. And so others that are coming out with newer models are taking market share. And so you're not going to generate very good returns on invested capital under these types of business conditions, under these types of competitive dynamics. And you've seen that with Ford over the last decade. Only briefly did they have a return on invested capital that even approached 10%. So finally, let's look at valuation. And as you can see, it's very cheap. It's trading at a forward price to earnings of 5.3. And it's because of all of those downsides of the car business that I talked about. It's not just Ford that's selling at a cheap valuation. I could show you GM, Stellantis, and others trade at very low valuations because the car business is not attractive for investors for the reasons I mentioned already. And there's many more reasons I could continue on about, but that would be a much longer video about why the car business is not attractive for investors. And so you have this valuation. This is about 1/4 the valuation of the average stock in the S&P 500. So it's trading at a valuation of about a quarter of the average value of the S&P 500. And then if you look at my discounted cash flow valuation model for Ford, my intrinsic value per share came in at $2.10. Market price is $9.74. So while if you look at Ford's forward price to earnings ratio, it looks really cheap and it could be tempting. If I was to rate this stock as a buy, hold, or a sell for 2025, I'm rating it as a hold for 2025. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.